As part of our Currency Alpha Strategies series, Currency Investor talks to Heinrich Pedersen, Chief Investment Officer of Pareto Investment Management, about investment opportunities within emerging market currencies. Heinrich, some currency managers still fear investing in emerging market currencies. Why do you think that is?
Well, I think it's probably a couple of reasons. One is lack of availability of data. So for a typical quantitative manager, it's difficult to analyze emerging market currency returns or emerging market returns with a long enough time series to validate any kind of hypothesis they may have of whether money can be made or not. And I think also there's just this this sense that emerging market sounds dangerous. And even though they are becoming less and less so, people will still remember the Asian crisis of '98, and they will think that that's something that can happen again tomorrow.
In some parts of the world, political risk is a dominant issue for investors. Do you think traditional investment rules and risk management techniques can still be made to apply when looking at investment opportunities in EM currencies?
Well, that's a very good question. I think obviously political risk is a key element of investing in emerging markets, and it's the kind of risk people have been paid for taking on over the past 5 to 10 years. The key difference between emerging and developed market obviously is the rule of law and property rights. And we know in many countries, like for example Russia, where that doesn't apply particularly strongly. So I think it is a key consideration when investing in emerging markets. On a currency perspective, it's slightly less, because in many cases the currencies do not offer an investment into let's say a factory that can be taken over by the government if they should decide to do so. So the rules govern, the considerations are there because it impacts the attractiveness of investing in a certain country and thereby also its currency.
What do you believe are the key challenges of investing in EM currencies?
I think the key challenges is that going forward, I think a lot of people have been looking at emerging markets as a block. So it's been like one asset class. I'm investing in emerging markets. I mean, even if you read in the FT a month back, people were talking about how institutional investors should invest into emerging market debt as a asset class. But obviously all these countries, I think there's probably 15 or 20 of them that are investable. All these countries have different financial policies or fiscal policies, monetary policies. They have different growth patterns. They have different export, imports, etc. So there's a lot of differences between these countries that, is hard to get to know. And so you suddenly expand, everybody knows European or US economic numbers and what's going on because it's well publicized. Many of these countries don't necessarily have the same quality of data, the same frequency of data, and the same accuracy of data. So evaluating these countries is a harder task. And I think the challenge going forward is that people have been seeing them as one block, whereas it is, as a matter of fact, a lot of individual countries with a lot of different risks and different opportunities.
Okay, great. Some research has suggested that trend-following trading strategies work better for emerging market currencies, while carry trading strategies perform better across developed market currencies. Would you agree with that? And if so, why?
Yeah, well, I was actually surprised to see the question first. I'd like to see how that research came out. It is true that if you're looking at this relative short time series, and I think I mentioned that initially, there's not that much data. In many cases, you have maybe 8 to 10 years of data, whereas in developed market, you have got 30 years or even sometimes longer, ever since 1973. So if you do an analysis on developed markets, you can, with a higher degree of certainty, at least say what worked in the past. Whereas with emerging markets, it's somewhat more difficult. I think the problem looking at these types of generalization about what has worked and what is better is that your numbers will show what worked in the past, but obviously not what will work in the future. If you're looking at emerging market, it has really been a one-way trade ever since 2001, 2003. Emerging markets, as a general rule, have strengthened versus the US dollar. That means that whether you went in there for carry or a trend-following strategy, you would have done very, very well. So is one better than the other? I think it's, if you look at emerging market carry, there's been higher yields than in developed market carry. On the other hand, you know, if you look at individual countries like Russia or Brazil, there has also been some very large devaluations. So you would characterize an emerging market carry trade as having a lot more downside risk probably than a developed market carry trade. Again, I think going forward it's a different picture. I think there's a lot more differentiation going on. I think that the emerging market trade is probably getting more crowded. Everybody's trying to do the same things as they've been doing for developed market. Everybody's looking at emerging market as an asset class. And so I think, you know, there's not necessarily going to be the old rules that apply.
Okay, and in what ways do you feel currency managers need to adjust their trading style when dealing with EM currencies to ensure they're adequately positioned to mitigate risk while still being able to deliver attractive yields?
Okay. Well, I think in terms of like looking at emerging markets, as some of the what we call emerging markets are actually getting quite developed. So in terms of certain countries like, you know, dollar Brazil or dollar ruble has similar turnover, like say for example as dollar Swiss franc. So, you know, it is getting more and more efficient, the market is getting more and more liquid. However, the key things I think with looking into emerging market is to looking at obviously at your exit risk. Because what is more typical for an emerging market than a developed, and even the ones that are quite, you know, far ahead in the developing cycle, is that, you know, there's a lot of liquidity when you enter into the trade, but when you exit it, there's a lot less. And we did see that also in developed markets in October of 08, for example. There was big gaps in the Australian dollar, New Zealand dollar, etc. However, for emerging markets, that is amplified to a large extent. So I think the key thing when looking at emerging market is to looking at the transaction costs in a crisis. You know, what is actually the price you can get in and out at, you know, once something happens. And it's very difficult to establish that what it was in the past because there's very little data. I know, for example, in the Russian ruble, when it devalued, when the state went bankrupt, literally back in the early 2000s, you know, there was forward prices 1 month were quoted with a 40% spread. So that clearly impacts whether your investment was ever going to be profitable or not. And you know, these things can continue to happen in the future as well.